Hello, friends. The years 2020 and 2021 were fantastic years for stock market traders, especially the bulls. We actually saw humongous amount of returns, outsized returns coming in for the bulls. Is the year 2022 likely to offer the same prospects? Even if not for the bulls, maybe the bears. After all, you and me are traders who basically intend to garner trading profits, put food on the table, irrespective of the fact whether we go long or we go short. In my humble opinion, I believe the market dynamics have changed. On my social media accounts, I have been warning you about a higher inflation, done. Rising cost of funds, done. Challenges to the emerging markets, foreign exchange peg, done. Turmoil in the bond market, done. And shift of asset allocation from equities to fixed income, happening as we speak. And also remember, on my social media accounts and in my videos at Equity Master, I have been very clearly debunking the theory of the super cycle in metals. Now that all that is unraveling, what is the game plan that a sagacious and a careful trader, a hard-nosed trader, should follow? I can only share what I intend to do going forward in the remaining part of 2022. As my friends and followers, I intend to help people become better traders and garner higher trading profits. The idea is to put you ahead of the crowds and enable you to stay sharp. So, in the year 2022, first of all, I expect pro-cyclicality in the economic scenario. What is pro-cyclicality, you might ask me? Now, pro-cyclicality is when asset prices and the real economy come together and move in the same direction. In the year 2020 and 21, you saw counter-cyclicality. Counter-cyclicality is when asset prices and the real economy are actually moving in opposite directions. So you saw industrial lockdowns, but stock prices going up of companies on zero production. That is a prime example of counter-cyclicality. Now, counter-cyclicality is invariably followed by pro-cyclicality and vice versa. So the year 2022 will see pro-cyclicality. Now, either the economy shoots up to justify high prices or the prices of these assets come down sharply in tandem with the economy. I think the latter possibility looks more realistic. Now, markets in 2020 and 2021 went up due to easy availability of low-cost funds. In many cases, also zero-cost funds because bond yields were giving you zero. In some cases like Germany and Denmark, etc., there were also negative returns. So it was actually paying people to borrow funds. That led asset price inflation. Now that cost of money is rising, the money tap is getting turned off. Now, when the money tap is getting turned off, bulls find less and less money to play around with, which means the endless or seemingly endless supply of inflows into the stock market will slow down or maybe even stop. So that means that the bulls are not likely to have it easy going. Take, for example, the recent announcement by the US where the mortgage rates went up to 6.28% from 5.50 as early as last week. So within a week, you saw a humongous rise in mortgage rates. Now, what will happen is that home sales will possibly slow down. That will hit the sentiments and prices of industrial metals. And since there will be mark-to-market losses in industrial metals, there will be unwinding even in agricultural commodities, in some cases, of course, and definitely in energy prices. The sharp sell-off you saw in natural gas prices on 14th of June, that was 15%, and 8th of June, a little over 10% in one day, is a precursor to what I'm expecting in the year 2022. There will be very quick, very brief, very sharp sell offs where people will lose their shirts. Statistical beta or pure price volatility will jump through the roof. It's not surprising whenever markets turn, the sentiments are suddenly changing from bullish to bearish. People take time to adjust to the new scenario in the market, and before they can react, prices have turned on them, and then there are panic triggered decisions, which raises the statistical beta. Now, as beta rises, exchanges will come down and raise span margins or deposits for traders to trade, which means trading might become more expensive. The game itself will become more capital intensive. You will require more and more money to play in the futures and options market. There will also be a fallout for screen based traders and micro trend traders like me who ideally would like to keep their trade open for no more than 1 hour at one time. The bid and offer spreads will rise. Why? Because the volumes have come down. Remember, it's become more expensive to trade. And you will see prices getting thrashed around the place, all over the place. And that is likely to raise the challenge level for an average retail trader. So, one of the things that I intend to do is reduce my footprint of exposure in the markets and keep the profit target and stop losses a little more wider. That seems to be a sensible thing to do. George Lane, the father of the stochastics oscillator, is reportedly is reported to have said very famously, of course, that bear markets are like diarrhea. They fall quick and they fall fast. Now, why did he say that? I'm going to record a separate video on this, so please stay tuned and subscribe to my YouTube channel to stay abreast of the cutting edge ideas that I intend to share with you in the coming future. But suffice it to say that the old saying, markets climb up the staircase but fall down the elevator shaft extremely fast, will be seen in the remaining part of 2022. So this is something that I've also mentioned in my video on bear market rallies, which I made on 8th of June 2022. Please see that video. It'll basically give you a whole lot of idea on what you need to do in the remaining part of 2022. I expect the domino effect in the remaining part of 2022. What is the domino effect, you might ask me? Now, this is something that every behavioral technical analyst must understand. You see, the guy who's trading equities, commodities, currencies, and maybe even bonds invariably remains the same. He's one guy who's putting money in different baskets. He's placing his eggs in different baskets. Now, when his money in one particular basket is going down the tube, there is obviously likely to be worry, there's likely to be depression, there's likely to be a feeling of panic, and he might try and pull money out of all baskets. So the decline in one mass market or one asset class can trigger declines in other asset classes. So you might be naive enough to say, oh my God, natural gas fell 15 and 16% on 14th of June. But what do I care? I only have equity shares of companies that are in the oil and gas business. Why should I bother about my trade in the foreign exchange market? Because commodities fell. You know something? Each market or asset class is married to each other, is in bed with each other. It's the same guy's money that is going in commodities, currencies, bonds, and equities. And when he takes a big punch in one asset class, he tends to withdraw money from the other asset classes as well. Now, this is something that people don't want to talk about in the public domain. I've realized whenever my videos, which I talk hard-hitting negative news coming in the market or negative developments coming in the market ahead, we tend to see lower views on them because people don't want to hear bad news. and good news sells well. So you're inundated with good news. But I do expect the domino effect in 2022. Now, what's the plan of action? Like a lion targets the weakest and the slowest deer when it's hungry for lunch, he chases after it because it's the easiest to catch, kill, hunt, and eat for lunch. I'm deliberately targeting those stocks which are A, weaker than the market, and B, over a period of time, as I discussed in my bear market scenario video of 8th of June, I will target those weak stocks which have seen a huge amount of hope based MWPL rising. Now, what is MWPL? MWPL stands for market wide position limits. These are limits or exposure extent which traders have utilized as compared to the absolute limits permitted by SEBI. So if the MWPL of a stock is 30% and SEBI has allowed 10 lakh lots on it, you can remain assured that people have used nothing more than 3 lakh lots, which is 30% of 10 lakhs, and they are feeling cautious because they are unsure about the prospects of this company. So, be that as it may, I will choose those weak stocks where MWPL has risen sharply in the last 3, 4, 5 weeks, because when hope, greed, and optimism are shattered, disappointment, depression, fear, and panic must set in. Those stocks are the best targets for hitting hard. And you must hit them hard and you must hit them fast. These selling windows will be very brief. Remember what George Lane said: bear markets are like diarrhea. They are quick and they are dirty. So you blink an eye and your opportunity is gone, and the biggest part of the fall will be lost. You must get in quick and get out quick as well. Now, theme and concept stocks. Invariably, what you will see in financial markets is the narrative, the story, the build-up of ideas. The same thing is repeated day after day, week after week in the mainstream media, on social media, via chats and messengers and WhatsApp and Telegram and whatnot. Now, since these stocks have been pushed, theme and concept stocks have been pushed across the board, and people have got induced into buying them, these tend to be the most vulnerable whenever the markets dovetail or waterfall like declines occur. Note these stories and note the change in MWPL on these counter along with traded volumes and the ATP versus LTQ relationship on your snapquote window. Whenever the snapquote window tells you it's time to short along with the MWPL, it's time to go. The other game plan that I have is I expect the cost of funds to go up. This is something that I have been talking about on my social media pages since many, many months now. I will target those stocks whose companies are in the business of depending on sales based on EMIs of the buyer. Now, since cost of funds are going up, EMIs will also go up. So a company that is heavily dependent on EMI based purchases will automatically see sales of its product coming down. Like me, there are a whole lot of other traders who think so too. They will either stop buying those stocks or even hammer them, which is why these stocks are a self-fulfilling prophecy. Because a lot of people expect them to fall and they sell them, they do fall. I'm going to go after these self-fulfilling prophecy stocks and hit them when I think interest rates are getting to a point where the skew is shifting from equities to fixed income. I don't expect falls to be one-sided. There will be falls, very rapid falls, followed by very, very small sliding affairs where you will see a 25, 30 naya paisa fall in every half an hour, 1 hour, 2 hours, maybe even in a day. And like I said in my bear market rally video, there will be sudden but sharp spurts in bear market scenarios as well. Would I like to buy into a bear market rally because, hey, as a trader, we need to be neutral, we need to be agnostic? How does it matter whether we buy or sell and make money? Now, this is something that is a personal question. I've often been asked, Vijay, would you like to buy in a bear market rally? Personally, I will not buy into a bear market rally for a few reasons. Number one, it's temporary. Number two, it reverses without a warning. And number three, it's extremely slippery to catch. So, why get into something where the odds or risk reward ratio is not in my favor? However, if you feel that you're quick enough, nimble footed enough, adept enough to capitalize on every twist and turn in the price in the market, all the more power to you. Please go on right ahead. But hey, that's just me. I will continue to ladder up my fixed income investments. This is something that I have been sharing with my friends and followers and my online family on my social media accounts. This is something that I have been doing with extreme amounts of discipline, and I intend to continue to do so. Because this is not just about the 6, 7, 8, or 9% return on investment that I get on laddering these investments. That, of course, is welcome. When stock market prices are falling, I'm still positive by 6, 7, or 8% per annum. That's, of course, welcome. I welcome it from Mother Market. But that's not my target objective. My target objective is to safeguard my capital and keep a war chest accumulated for a time when the market and my in-house statistical trading model, the IBEX, tells me, hey Vijay, it's time to buy. At that point in time, I'll need a whole lot of capital to go out there and start nibbling into stocks again. So I will continue to save money in the fixed income portfolio and do asset allocation, which I'm so used to doing. Why keep all your eggs in one basket when you can keep shuffling your money like a chessboard? Do remember, I have often told you in my previous videos, the market is like a chessboard. Your money is like the chess pieces. If a trader keeps his chess piece constant on that chessboard without moving it, death is certain. You have to keep shuffling your money from the least optimal return to the most optimal return at any given point in time. That's my theory of staying ahead of the market. Friends, I hope you like this video and you subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad, or ugly, I always welcome your comments and feedback in the comments section. And help me reach out to smart investors like yourself by referring my video to your family and friends and all other social media groups as well. I thank you for your patience, and I assure you my videos will continue to keep you ahead of the crowds. Till we meet again, this is Vijay Bambwani signing off for now. Take care. Bye-bye.